Now, private credit markets are taking a huge hit too, but this trend existed before the war started. It's more in the confidence in the market and the concentration that they have within certain segments of their investments and the lack of public data that they present for investors. Now, some people might not know what the private credit market is, but it's often referred to as the direct lending market. It is a segment of the financial world where non-bank institutions such as private equity firms, hedge funds, or specialized credit funds lend money directly to companies. Unlike traditional corporate lending, these loans are not issued by commercial banks and are not traded on public secondary markets. And that's why there's a lack of data. So they're completely unlike corporate bonds or anything issued by businesses or the government. So the private credit market has been deteriorating for the last 6 to 9 months. If anything, the war is distracting media coverage on this issue because it should have been blown up much more than it has been. But when you have a war going around that can disrupt the entire economic system of the world, then you're not going to be thinking about private credit only. Now, investors are going to have to make a decision if this is a systemic issue like 2008 or something that can be fixed with a quick pivot. Now, these companies are highly levered, so that is an issue. You don't want them to default and cause a huge ripple within the banking and financial industry. But looking at how investors are reacting, they are being cautious and they are looking at the financial sector as something to be wary about. The Fed might have to help to create some ease for this, but with the war going on, you can't really rely too much on the Feds right now. Overall, the conditions, if they start to improve slightly, then you might want to get in because at these lower prices, these companies historically have shown great upside. Definitely keeping an eye on this and slowly maybe trickle some money in some of the top guys or some ETFs that are focused on the private credit market. I mean, with that, the financial sector is definitely seeing some shakiness, but surprisingly, the banks are holding up much steadier than expected. And that could be good for confidence, knowing that people aren't at the highest level of fear, even with the geopolitical conditions and the slight micro conditions within the financial sector and private credit sector.